Wow. Two words, valuation matters. One of the hottest high growth stocks on finance Twitter, finance YouTube, and of course, Wall Street just crashed. And if you know my channel, you know I hate the overuse of the word crash because it just spreads fear, and that's not the mission of this channel. But there's really no other way to put it in this case. So is this revolutionary new fintech stock still a buy? Why did it crash? What's the valuation look like? And what am I doing? All of that in this video. Let's do it. My name is Matthew, and today we're talking all things Upstart, ticker UPST. Give me the format. First, a super brief overview and refresher of Upstart and how we got to this point today. Next, the pros of their latest Q3 earnings, the good stuff, and then the cons of their earnings report and why I think the stock dropped. Finally, the valuation and what I'm doing. Let's set the stage a little bit. So in one sentence, Upstart is a fintech company that uses its proprietary risk model, artificial intelligence, and billions of cells of data to originate loans for people who are wrongfully neglected by traditional credit metrics like the FICO score. In other words, if you have a bad FICO score, but Upstart's AI says based on all these other inputs and data points, you're actually more creditworthy than it seems, we'll help you get a loan. Upstart then receives origination fees, which is how they make the majority of their money. This is obviously a fantastic and revolutionary application of artificial intelligence. Much of management is ex-Google, and in this case, AI is not just a buzzword. And lastly, from an investment standpoint, they are growing revenues at triple digits year over year, and they're a profitable company. So it's partially why I first talked about this stock in late February of 2021 at about $100 per share, and I last talked about this stock most recently on September 8th, 2021 at roughly $270 per share. At the time of this most recent video, I was on the side that it was still too expensive and I was not buying this stock because of the valuation. I had to stay on the sidelines despite how hot it was and how impressive the growth seemed. And like that looked pretty dumb as it continued to run 42% in the following weeks, but now we're back to about 10% lower than when I posted that video. I think sometimes people misinterpret my stocks to watch videos as stocks to buy, and my stocks to watch videos is stocks I'm interested in, but there's always at least one or two things I don't quite like enough to buy, and in Upstart's case, it was the valuation. So now that we're down nearly 36% from recent highs, what do we do? Well, here are the highlights from their most recent quarter, and trust me, you're going to want to see all of these. First, revenues came in this quarter at $228 million, up 250% from the third quarter of last year, and up 18% sequentially from the last quarter. They also increased loan originations by 348% year over year, from 81,000, just under that, to nearly 363,000. They're now operating on 28 billion cells of data, which is, in simplest terms, improves the accuracy of their artificial intelligence and risk model. This allows them to almost expand their immediate addressable market because they're able to loan to riskier potential clients with more accuracy and continue to be more accurate with others. Their bank partners 3x'd in the past year, with their most recent bank partner going live on the platform in less than 50 days, which is a very, very fast onboarding process and just proves that they are ready to keep scaling at this pace. And funny enough, this is actually a big concern for me when I was first looking to Upstart at the beginning of the year because they only had around 12 bank partners, and I wasn't sure if they had found product market fit, if they had found something that a lot of banks were willing to get on board with. But that's actually what makes this next highlight so amazing. A year ago, all of their bank partners used FICO scores still as sort of a guardrail for their AI originations. But now, not just one, 4 bank partners have eliminated the requirement for the FICO score and now rely on Upstart's risk model almost entirely to properly assess risk. This is kind of insane. It's pretty much unprecedented. And the last one I'll highlight here is their auto refinance business is just starting to gain traction, reaching 4,000 auto refinance loans across 47 states versus just a handful in one state a year ago. Now, according to management, these loans will have similar unit economics to that of their personal loans, which is good to hear. And note that this is not the same as their auto retail loans through their acquisition of Prodigy, but I'll touch on that later because it's pretty big. So yeah, these are the key highlights, and personally I think those highlighted in green are the most impressive and important for this past quarter. And it's hard to see that with all of this, Upstart still fell 20% after hours, and I'll explain why I think so in just a minute. But first I want to cover the new products and innovations and updates that Upstart brought to the table in their conference call. See, when you're investing in a company at this valuation, you have to expect them to almost bring new innovations innovations to every single earnings call, or at least big updates on previous innovations? Otherwise, is that valuation really justified? In the third quarter, Upstart rebranded Prodigy Software to become Upstart Auto Retail, and so far it's been a hit. They now tripled the number of dealers on the platform compared to a year ago, and in Q3, Upstart added an average of more than one rooftop a day. Additionally, this past quarter, the first ever Upstart-powered loan was originated through their auto retail software. So far, they've signed 7 bank partners on for the auto lending platform, which is also a great start. And in terms of financials, here's the best part about this new product. The auto retail lending unit economics are going to look even better than their personal loans and their auto refinance loans because there's a lower cost of acquisition. In other words, this is going to be one of their highest margin products. You see, customers are already at the point of sale, and according to management, some of the operations required to generate the loan are handled by the dealers. This leads to higher margins in the auto lending market, which is at least 6 times the size of the personal loan market. So now you've got, again, higher margins and a larger TAM. Moving on to the new products that they have announced in their conference call. So first, they're working toward a small dollar loan product designed to help consumers with unexpected and immediate cash needs. So think a few $100s that would be repaid in just a few months. And second, they want to provide fast, easy access to affordable installment loans to business owners across the country. They hope to bring both of these new products to market before the end of 2022. And finally, they have officially announced plans to move into the mortgage market and will, quote, invest significantly throughout 2022. And they say, while this initiative has a longer time horizon on it, we feel it's important to share our intentions right now. To me, this translates from earnings call speak to, we know we're trading at a very expensive valuation, and we need to give Wall Street something to look forward to. That's a big announcement so they won't tank our stock, please. And that right there is a perfect segue into the cons of their earnings released and why it tanked, because obviously that last little trick didn't help. Starting with technology, the number of loans that were fully automated on the Upstart platform is down slightly to 67% this quarter from 71% last quarter. Now, in my opinion, this is a short-term pain for a long-term gain. This is good news for long-term investors. The reason why the number of automated loans is down is because they're starting to reach into new borrower profiles with much lower credit. So the model has to be more careful when first learning about this new demographic, but ultimately it's great news because Upstart will be able to reach more underserved customers. There's also mention of a larger volume of organized attacks on Upstart to try and get fraudulent loans, which also contributed to this decrease. It's a tough decrease, especially considering lending clubs in comparison is over 80% automation for their loans. But again, Lending Club is lending to borrowers much closer to prime credit. Now, before we get into the bad news for financials, this is what you have to understand. When you're trading north of 30 times revenue and your stock is up hundreds of percent leading into earnings, Wall Street does not care why your numbers stalled or why your numbers went down. They just see that they're no longer going up in exponential fashion. Simply put, you are expected to be flawless by Wall Street, and anything less than that will be punished. And all of their year-over-year numbers for Upstart sound great, but since they're in this hyper-growth stage, Wall Street and most investors will be paying attention to quarter over quarter. So with that said, let's dig into their financials. For example, their contribution profit was $6 million in Q3, up 184% year over year, which sounds great, but this is a 46% contribution margin, which is down from a margin of 54% in the prior year. And yes, acquisition programs and auto loan rollout can affect this margin, but Wall Street doesn't care. And you see them stall for contribution profit here on this chart, and they also drop for net income quarter over quarter. Again, very closely watched for their hyper-growth phase. On top of this, their guidance for Q4 of 2021 expects contribution margin to stay lower at 47% and net income to continue dropping quarter over quarter. Now, for my long-term investors out there, this is short-term stuff. Let me be very clear that this is still going to be a beast of a business. But take this as a lesson for entries into new positions, that this is all it takes to send a stock crashing down that has such extreme expectations priced into it. Someone in the conference call even blatantly asks here, still the magnitude of your beat for this quarter has diminished. I mean, are you kind of entering a phase where what you're guiding to and what you'll deliver, do you expect that accuracy to increase and thereby that magnitude of the beat to be lowered as well? This right here to me is proof that Wall Street analysts, even private investors, they didn't care if they beat, they cared by how much they would beat by. and they didn't beat by enough. All right, so let's dig into the valuation and what I'm doing. This is what the comps table looked like when I bought into Lending Club in mid-October. We're looking at next 12 months EV to revenue, and you can see that Upstart and Affirm are trading way above everyone else. So when I first alerted investor community, link down below if you'd like to join, about Lending Club nearly a month ago, my thesis was that Upstart was overvalued and Lending Club was undervalued. Thus, they would eventually come together and meet in the middle. Now, we can see that this is pretty much exactly what has happened today, and now Upstart is actually starting to look somewhat attractive again. Now, part of the decrease in Upstart's multiple is because expected growth rates did slightly increase, so that increases the size of the denominator and therefore brings the multiple lower. But most of it is obviously from the 36% decline in Upstart's stock, bringing it from 32x to 19.7x. And now Upstart is getting closer and closer to that 15x EV to revenue fintech average multiple. However, this one on the chart you see here is trailing 12 months, and Upstart's 19.7x is forward looking. So what am I doing here? Well, you can't deny that Upstart is looking cheaper here. I mean, the stock price is literally going down, so it's inherently getting cheaper. And you also can't deny that their business fundamentals do continue to improve. There's a slight speed bump, a slight deceleration in some of their growth in terms of profitability specifically, but revenue growth still looks great. They're rolling out new products, rolling out innovation, and the innovation contributes to their financials in lumps. Now, let me just get to the point. It still has a bit further for it to drop, in my opinion, before I want to pull the trigger. I'm not saying it will drop there. I'm saying I'd be more happy if I was buying shares again in like the 180 range. And maybe that's me being greedy. Remember, you can be greedy on both sides of the coin. You can be greedy by saying you want a stock that's so cheap that it might never reach that point. And if I do never get shares in the 180 range or something lower than that, then it's okay. I have to accept that the market's willing to pay more for Upstart than I am. And of course, I do have this position of 11 shares that I will continue to hold on to, and this is my position in Upstart just for transparency's sake as well. I hope you guys enjoyed the video and found some value. Subscribe.